Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
In today's episode, we'll cover the common misconceptions about home and investment property finance. These misunderstandings can actually delay your property journey and even limit your borrowing capacity. Let's clear up these misconceptions for you today. So the key one we see with people is the view that they need to save a 20% deposit to get into the market.
Yeah, I've had numerous conversations with clients about this where they're waiting to save a 20% deposit for their home, whilst, the reality is that if they put a smaller deposit, they will be able to fast track and move into their own home or buy that investment property sooner.
I think the challenge people run into is thinking that LMI, lender's mortgage insurance, which is payable when you're borrowing more than 80% of the value of the property, is a sunk cost. Well, to a degree, yes, it is a sunk cost, but you need to really weigh up the pros and cons of being able to get into the market sooner versus later, because we've seen people just miss out on the market.
That's right. Saving up a 20% deposit in the current climate for your first home at least takes about 10 years as of 2024. So 10 years is a very long time. And in that time, property prices may actually double. If history is to go by, property prices have been on the rise and we have a massive shortage in Australia. So the time it would take you to save up that 20% deposit, the market will move way further ahead in that time, and the capital gain will actually outpace your savings rate.
Yep. People also need to see that there's government incentives, right? If you are a first home buyer, if you're a permanent resident or a citizen, the government is now offering the first home guarantee schemes where you can get into your home with as little as 5% deposit, with the government guaranteeing 15%, where you don't pay lender's mortgage insurance and you get interest rates equivalent to what someone with a 20% deposit would get. It's made a lot easier for people to get into the market. There's constraints though, right, to get into that?
There are certain eligibility criteria that you need to satisfy to be able to get that 5% deposit and LMI waiver. However, even if you had to pay LMI, you could borrow maybe as high as maybe up to 95%. But again, you have to look at how much LMI are you paying? Are you able to save up a little bit more to save on LMI? And weighing the pros and cons of that. But personally, having built a portfolio, starting with our first homes, we utilize LMI to our benefit, and it's actually paid off many times over. It's a matter of, paying someone else's mortgage if you're renting, or, missing out completely on future gains. And if you're a property investor, then also you can pay LMI you generally need about 12% deposit, ideally.
That's a sweet spot as well to get best bang for buck for lender's mortgage insurance. And LMI does rise sharply over 90%, but it is worth considering because how long will it take you to save that deposit?
Yeah. So if you are in that position where you have been saving for your home, it would be worth considering if you are able to actually get into your home or that next investment property sooner, because the upcoming gains may far outweigh the cost to you.
And there's also benefits if you are an industry professional. You don't need to save that 20% deposit, where if you're, say, an accountant or a lawyer and different professions.
But it is chartered accountant or a CPA of sorts, certified practicing accountant. Yeah. You might be a medical professional, or even nurses at times get LMI waivers with some lenders.
So that means you can do with maybe 5 or 10% deposit on your home or investment properties. Obviously, every lender has a different policy, so you do need to find out or explore or work with your broker to figure out if you're eligible for it. But it's very beneficial. So the gist of it is you do not need a 20% deposit to get your property journey started.
our view is, you need to be in the market as soon as practical. And even if that means paying LMI, it's not as bad of a thing. It is actually a misconception. It could actually pay off pay off sooner than later. So we would encourage you to consider if this is something that works for you.
Well, for example, right, if you are, as I mentioned earlier, that 12% deposit or 88% loan to value ratio is the sweet spot to minimize the LMI you will pay and maximize the benefits and the borrowing to yourself. Consider it being 2% of the purchase price, where your overall loan is 90% of the value of the property. It would help you, obviously, to get into the market and minimize that cost that you're capitalizing. And with investment properties, personally, for what our accountants did was also maximize the tax benefits that LMI can have. You can write it off over 5 years.
It is a borrowing cost. So check with your accountant. So you may be able to write it off over a 5-year period. So for example, you incur a $10,000 LMI bill, which is added to your loan. Generally, you'd spread it over a 5-year period, but obviously always seek tax advice on that. So, and it's, if it's a rising market, which it has been in particular pockets in Australia over the years, then it's even more important, because when property starts rising in a particular region and it goes through a boom, there would be substantial gains, 10, 20, 30%, in a short span of time. So, yeah, so just weigh that up. But just another thing with LMI is there's a misconception that it protects you.
Yeah,
which is not true.
It protects the banks. It's you pay for it, but it's protecting the banks in case you default on the loan.
Yep. So it's not protecting you. So just be mindful of that. It's protecting the lender. It's just a cost to get you in the market sooner.
On the flip side, though, right, being devil's advocate, paying LMI does mean you're paying more interest over the life of the loan. Yes, you are. But would the gains outweigh the costs that you are paying for it?
Yeah. And once, your loan to value ratio drops, when the value of your property increases, the loan to value ratio drops, you will have the opportunity to refinance at a better interest rate.
Yeah, because interest rates are higher when you're paying LMI. But what many people do is they do potentially consider refinancing, or you can also, it might benefit you as well when it comes to tapping into equity if you have paid LMI, because provided you have the borrowing capacity, let's say the value of the property increases, so LVR is reduced to say 70%, but as you have paid LMI, you can go to the same bank and say, can I top up all the way to 88% and only pay more further lender's mortgage insurance on the equity you are tapping into. But most banks would want you to have a pre-approval or be able to service for the pre-approval for that next purchase to enable that.
I've had a number of clients who have paid LMI on their first home, and then when the value of their properties increased slightly or a bit more than slightly, they were able to tap into the equity up to the same original loan to value ratio. And they were able to use that to purchase their first investment property. So for that reason, it is important that you select the right lender, which will actually allow you to do that, because not all lenders are okay with releasing equity when you have paid lender's mortgage insurance.
Yeah. Moving on, also we've seen the thought process or misconception in the market that you have to save up a deposit for that next property or sell your current property to get into the next property. That's lost opportunity over the long term. That's massive cost with entering the market because you've paid stamp duty and then selling costs and capital gains tax to exit from a property to hop on to your next one. And that's where tapping into equity is useful, right? We've had many clients do that.
It is a borrowing against your property. So you will be paying interest on that money. But that is really the fastest way to be able to expand.
To tap into the equity rather than selling your property.
Yeah, that's right. So tapping into the equity is the fastest way for you to be able to take that step. And perhaps this is not the right time for you to sell the property. Perhaps, there's plenty of gains left there. Perhaps you may have, you may be able to take advantage of the next 1, 2, 3 property cycles in your particular region, wherever your property is based. So rather than getting rid of this property prematurely and then cashing out to put a deposit on your next property, it's better to tap into the equity.
But make sure you get some tax and credit advice, because in some cases it may make sense to sell the property if it was your former home, for example, if there were tax benefits on that.
Or it's a loss-making property and it hasn't gone anywhere and it has had very low capital growth in comparison to the market.
Yeah. And then the next one is thinking that you only need to save for a deposit. People think we only need, say, a 20% or 10% deposit, or on a 500K property, we only need 100 grand to get into the market. But you need to think of other costs that are involved in acquiring property, which includes stamp duty, solicitor, buyer's agency costs.
So you must access all the equity that you're able to at any particular point in time. I've had clients say to me, well, I only really need 150 grand for my next property, whilst they're able to, say, access $300,000, which could fund 2 properties for them, but they are adamant that they must access 150K. And at times they come back 6 months later, a year later, and they say, well, actually, I want to buy another property. It's better that you tap into that equity in one go and have your deposit, stamp duty, costs, etc., ready to go, not for what you're doing right now, but for the future as well. So one of the misconceptions that people have is that if they're paying off their credit card every single month, then it shouldn't impact their borrowing capacity. While in reality, credit card, it's like a limit that you have access to at any point in time.
So the banks are typically calculating it at 4%. So if you have a 10 grand credit card limit, 4%, which is $400 per month, is determined as your liability. So clients often, when they come to us, they say, oh, I pay my credit card every single month, so it shouldn't impact my borrowing. But no, the banks are saying, well, your cash flow every single month is lower by $400. And then there's also buy now, pay later facilities.
So they're a relatively new thing and they've been around for a couple of years now. People think that, oh, well, it shouldn't impact your borrowing capacity, but many lenders actually take these as credit card limits. So you may have these facilities, but some lenders may take it as part of your living expenses, but most take it as credit card limits.
And people do tend to forget declaring some of these items, and it has an adverse impact on your borrowing capacity. So when working with calculators and lending strategies, what we do is suggest to our clients, well, if you reduce this credit card by 5 grand, this is how much your borrowing capacity will improve. Or sometimes the loans may even be conditional on you closing your personal loans or credit cards or buy now, pay later facilities to enable that borrowing capacity and a good outcome.
Yeah. So just because you're paying it every single month in full has no bearing on your borrowing capacity. It's more so the limit you have access to that impacts your borrowing capacity.
Then the next one is the most interesting one we find. At times, clients might call us and say, but my friend got that interest rate. Why can't I get that interest rate? And it's always an interesting conversation because we end up just challenging them about what their friends borrowing.
Yeah, often you will just hear someone tell you or brag about that, they got this amazing interest rate. But the things that you don't know about is what sort of loan to value ratio do they have? Like how much deposit did they put? Did they pay lender's mortgage insurance?
Well, going back to deposit, they could have paid a 20 or 30 or 40% deposit, a very large deposit, which impacts the pricing they're able to get from the bank.
Yeah, many lenders price loans based on your loan to value ratio. So the larger deposit you put, the better the interest rate you could have. But again, you need a proper finance strategy to determine if that's actually the right thing for you to do in line with your goals. You may want to expand your portfolio, so that may not be the right thing. But when it comes to interest rate, banks do take that into account, and they may give you a better rate, say if you put a 30 or 40% deposit.
And then they may not have paid LMI because they were an industry professional. They might have been an accountant or a doctor or a lawyer, and they might have put a 5 or 10% deposit and still not have the interest rate that you are paying because, again, they're being priced as an 80% loan to value ratio.
Yeah. And then there is aggregate lending. So your friend might have borrowed $1 million, $2 million, $3 million, whereas you might have borrowed $500,000. So there's a big difference in those amounts. Yeah. So lenders look at aggregate lending, and that means it's really economies of scale. The more money the bank is making from you, the more likely they're able to give you a bit better discount.
And have you really considered, is your friend paying principal and interest or interest only rate? They might have completely forgotten or missed that opportunity to share with you. They might be paying an amazing rate, but they're actually paying principal and interest and not interest only. For all we know, their loans may not be structured optimally, and they're paying principal and interest on an investment property when they could be doing a lot better with interest only. And your loans may be just structured right, and you're doing it tax effectively.
So when next time someone tells you their amazing rate, don't take it at face value. Yeah. Consider, what could be the reasons for them having such an amazing interest rate.
And for all we know, they're stuck and not able to move forward. They're just with the wrong lender on an amazing rate and have massive opportunity costs.
Yep. So I've had people, right, who've been with lenders where they're unable to borrow any more money. Whereas there's another option, another lender, where they're actually able to tap into the equity and also fund an investment property. In those instances, they've chosen to stick to a lower interest rate rather than expand their portfolio. So your friend, again, as you said, Sana, that your friend might be with a lender where they're stuck and they can't move forward. That's a massive opportunity cost, because the capital gains that you could have on that next property that you could fund would far outweigh the small interest saving, really. So you need to look at the big picture with that.
That's right.
And another one is misconception is that I have a lot of equity and surplus money, so I should have the borrowing capacity to expand my portfolio. Whereas there's so many other factors that impact your borrowing capacity.
Well, there's your income, your family size, your expenses, your existing liabilities. You might have student debt, personal loans, credit cards, which impact your borrowing capacity ongoing. So having that surplus just on a day-to-day basis doesn't mean your borrowing would improve. You also need to consider that banks are actually assessing you on an interest rate a lot higher than what you're paying. So you might be paying 6% in interest rate, and then the banks add 3%, which is 9% or that you're being assessed on. That's with both your existing lending and new lending that you're taking out. So yes, surely you might have surplus of, say, $2,000 every month, but the bank's already assessed you on a much higher interest rate, which impacts your borrowing capacity.
The bank is really stress testing you to make sure that you're actually able to afford should interest rates keep rising. So effectively, it's protecting you longer term, just because you have the surplus or equity. Equity in itself doesn't generate borrowing capacity. It's really your income.
Sometimes people think I have got a couple of 100,000 equity that should improve my borrowing capacity, but no, it's not helping your borrowing capacity.
So say you might have surplus every month. So the solution to that is looking at your finance strategy, because there are ways to extend your borrowing capacity strategically, going to the correct lenders, which may be able to lend you money. And I guess that's where people get stuck with this. So they get married to their bank almost, right? Like you can't be married to a lender. It's about your financial future. The bank's watching out for their profit. They're not necessarily watching out for your goals. So you need to strategically work out if the lender you are with is actually the right lender, or even if it is the right lender, what are the ways that you can actually buy that next property or the one after that. There are ways around it, subject to borrowing capacity assessment and all, but it may not necessarily be with the lender you are with at the moment.
That's right. Then another one we hear time to time from people is, my broker gave me this product and they work for this bank. A bank finance manager is not a broker, right? The difference between a banker and a broker is a banker only has access to their one product, versus a broker is able to strategically figure out a strategy on which lender you fit in. And they might have access to 30 or 40 other options. Again, look, no one can really remember 40 options, but it's like which lenders are portfolio builder lenders, having access to those and being able to expand your portfolio. So a bank finance manager might show up as a premium banker, or you might feel the status of a premium banker, but all they're doing is giving you their product.
Yeah, and just because I guess someone has access to a gazillion lenders doesn't make it the right one for you, because there may be specific lenders which may have the right policies that fit your scenario. So it's not all about the interest rate. It's about where your scenario fits. How are you able to actually expand your portfolio? So I guess it's two extremes, right? Dealing with a banker and having just access to one product versus, someone who's access to the two products which will meet your needs or your goals. It's not about comparing everything under the sun that's on the market. It's about what will actually serve you with your goals long term.
And there's no one right answer to this. A bank finance manager is paid by the bank. They're a salaried employee. And look, if they're high performing, they'll soon be moving on to a better role. And then what do you do? But having strategic advice, credit advice, working with an investment savvy mortgage broker, you get strategy to move forward from one property to the next and the one after that, while saving tax, minimizing risk, and maximizing that opportunity available to you. So don't just think, you can go to your bank finance manager. It might feel like a privilege, but really you're just getting one product. You're not getting a holistic solution.
I guess it's good for the ego though, right? It's good for the ego that I have an account manager. I can pick up the phone to them.
But again, look, they're doing this for a job. They're not doing it because they correctly structure the loans. Yeah,
well, they're giving you the solution then and there. It's not about long-term strategic thinking. It's not really helping you progress. Yeah, it's good for the ego. You can pick up the phone to this account manager, but this is where you are. Like what's going to happen in the future? How will you expand your portfolio?
But when push comes to shove, will they be able to help you expand your wealth, expand that asset base or leverage that you have access to? Unlikely. In the short term, yes, it might feel good, but long term, it is not going to serve your goals.
Yep. So don't be tied to your lender. Look at the big picture. And I guess having been through the journey of having built a portfolio and having seen that journey, there's so much more people can do, and they get so hung up on where they are that they're actually self-sabotaging themselves.
Another one actually I've seen with clients is, and sorry to say, it is a bit of an ego trip, that the bank needs my business more than I need them. Well, no, the banks don't need your business. We as investors, being an investor ourselves, we need them more than the banks need us. Just realize in the bigger scheme of things, the banks have millions of clients across the country. They don't need your business. So feeling like you deserve a better opportunity or treatment from the bank beyond the constraints of their lending calculators, it's very misconstrued expectation that people tend to have from banks.
Yeah, so you're not entitled to it, really. You're not entitled just because you've been banking with them for 20 years, for example. You're not entitled to it.
Or because you hold a certain position in a job or in a business doesn't mean the banks owe you anything. So I think it's a bit of a reality and ego check here. Not everyone has that, but realize that you are playing with the rules the banks said, the policies the bank said. It's about navigating through it. And that's where an investment savvy mortgage broker would be able to assist you expand that property portfolio.
So take action, use a system to your advantage. Don't get hung up, or be married to your lender effectively.
Or your banker.
Or your banker, for that matter. Things evolve over time. You have to look after your goals, where your life is heading. And I can't stress this enough. Really, you have to really look at how could you best position yourself to succeed rather than having. And loyalty is good. It's a great attribute and we really value it. But you need to see, well, how am I progressing in my financial goals?
Thanks for listening. Join us next time for another episode of Property Addicts Australia podcast.